Hello, everyone, and welcome to today's webinar. This is Brant Dalby joining you today from the NinjaTrader ecosystem. Before I begin, I would like to do a quick test of picture and sound. Please type in a Y in the room if you can clearly hear my voice and see the projection in the room. Awesome. Thank you for the confirmation, and thank you all for spending time with us today. We have a very special event. We have Adam Halpern and Eric Synth of Indicator Warehouse ready to give you a wonderful presentation. NinjaTrader ecosystem is pleased to sponsor weekly partner events at a value-added service for our clients. These events are intended to provide increased exposure to our various trading styles and methods taught by our partners. So if you find value in these events, we hope that you will attend them on a regular basis. Now I would like to ask everyone in the room today a quick question. So if you could please choose the 1, 2, 3, or 4 on this poll screen, that will give me a gauge of what type of NinjaTrader users we have here in attendance. I'll start the poll here. While you fill that out, I wanted to remind you it is important to understand that there are substantial risks in trading Forex and commodity future contracts. You should carefully consider whether such trading is suitable for you, and that will depend on your specific circumstance and financial resources. It is possible to lose all the funds deposited with your broker and could even incur losses beyond these amounts. Please inquire at brokerage support at ninjatrader.com for information or for a copy of the CFTC full risk disclosure. Also, please remember that the ecosystem webinars are not a solicitation or recommendation, but simply education in nature. All right, thank you for filling out the poll here. We have about 40% of you are lifetime members, or excuse me, lifetime license key holders. Really appreciate that. And then we have a couple of you guys that are leasing the key, and then we have about 33% of you that are not using NinjaTrader. If you are one of those in attendance who has not used NinjaTrader, I'd like to invite you to download NinjaTrader absolutely free and get started with simulated trading, advanced charting, market analytics, and strategy development. This free version of NinjaTrader that you can download from the following link has no expiration dates, so you can use this for as long as you like. And I'll put that in the room for you. All right. We are very excited for this unique event in which Adam Harplin and Eric Synth of Indicators Warehouse shows us 3 things to do right now to become a better trader. Thank you again for attendance today, and without further ado, it is my pleasure to welcome to the NinjaTrader webinar room Indicator Warehouse. Please take it away, Adam and Eric.
Hi, folks. Let me just make sure, sound check wise, can y'all hear me okay, and the level's okay? So just give me a Y if you can. Great. All right. Hang on one second here. There we go. Okay, so first of all, my name's Adam Halpern, and I'm on today with Eric Senf. I'll introduce him in a minute. I'll be basically doing a quick introduction and then really behind the scenes during this presentation. So a little housekeeping piece. You're welcome to ask questions. While Eric's presenting, I will try and get to as many of them as possible while he's doing his presentation. If I think it makes sense to interrupt him, during whatever topic he's doing because it's relevant, I will. Otherwise, we can always address your question at the end. And if for some reason, and this happens, we miss your question or we don't address it, please don't take it personally. I'll definitely put our contact information in here, and you're welcome to ask us offline, after the presentation. So just real quick, that's me. I own Indicator Warehouse. I'm probably the 30% of you that are not using NinjaTrader may not have heard of us. Those of you that own NinjaTrader, I would be surprised if you haven't heard of us. We were one of the original partners in the ecosystem back when there was just a few of us, and I'm proud to say we've maintained a top level position ever since. So we started out actually as, the name sounds, Indicator Warehouse. This is way before people copycatted us. We were the original aggregator, if you will, of day trading tools online, kind of an Amazon.com for trading indicators. And what happened as we got feedback from our customers, we learned that people wanted more than just indicators to put together on their own. They really wanted systems to help them get a methodology for what they were trying to do, some guidance on how to do this thing called day trading. So we evolved from just carrying indicators on behalf of different independent software programmers to starting to carry a variety of software trading systems. And then about 2 or 3 years into that, we'd really gathered a tremendous amount of feedback from the user community on what the pros and cons of really what was on the market at the time. And so I took all that feedback and turned it into a requirements document, went back to the team and said, folks, this is what everybody wants and needs. Can we build it? And that led to the creation of what you see in front of you, the diversified trading systems. And really, that's what put us on the map. I mean, that's what we're probably best known for in the industry. Really twofold. One is the innovation that we brought is using classic diversification techniques that you would typically use for managing a 401 portfolio, right, to mitigate your risk through different types of assets. We took that down or over to the discretionary trading level, in which we use different trading systems, all designed to find different conditions in the marketplace at the same time, thereby diversifying your opportunity and your risk. In addition to that, and Eric will touch on this later, we were also one of the first to bring what some people call position sizing, sometimes risk management. It's different names, but the idea is that basically managing your assets, protecting your trading account using technology to make sure that you're trading correctly for that. So those are the two biggies. The other thing that I learned along the way is that, sure, people want to buy software, but those are just tools, right? What the people also want is the Bob Vila, if you will, to come along with those tools and teach people how to use them. So I went back to my original mentor, Eric Senf, and said, look, you're the best I've ever come across. Can I convince you to come on board and be our lead trainer and lead moderator? And as they say, the rest is history. So here we go. So I'll let Eric take it from here. I will just say this: when it comes to being a gifted teacher and trader, I've yet to find anyone sharper than Eric, and that's not to give him a big head or anything. It's just he's a gifted teacher, as you'll see in a bit, and very accessible. That's one of the things if you end up working with us, you'll see that we really believe in old school customer service. You should be able to get a hold of somebody and ask questions and get real support and not, get stuck in some kind of email nightmare. So with that, I'm going to hand you off to Eric. As I said, I'll be here in the background and back again at the end. It wouldn't be a webinar if we didn't have some goodies at the end. So yes, I definitely have some things that I will present to you as a thank you for your time today and for joining us. So stick around for that. Okay, Eric, it's all yours.
All right, thanks, Adam, for that very nice introduction. I feel like I need to go buy myself a bigger hat now. Can I just get a sound and visual check? I see Alex mentioned here that he's not getting the slides. Okay, Alex says it's working now. Great. My name is Eric Senft. I'm going to be your co-host here this afternoon, and what we're going to be talking about are why 90% of traders tend to lose money. You've all heard that statistic that 90% of traders are going to be unsuccessful. And if you've been trading for any time at all, you may feel like you're stuck in that 90%. Well, the opposite end of that equation, of course, means that 10% of traders are doing things right. So today we're going to take a look at what the 90% are doing wrong, what the 10% are doing right. This is universal information, by the way. When Adam and I decided to put this presentation together, we wanted something that was going to be universal, something that everybody could take advantage of, that it's not software specific or system specific, but that this is something that you can put to work for you right now. So To lead off, why are 90% of traders unsuccessful? Well, probably because 90% of traders are signal obsessed. You know, if you frequent any internet chat forum, you look at any of the Facebook forums or anything to do with trading, you follow the YouTube videos, everything is signal related. Traders are just obsessed about signals, and yet they still continue to lose money. The good news is that you can join the 10% of successful traders by doing the same things that they do. So in my private coaching that I offer to people, the mentoring and the coaching, there's three main problems that seem to come up time and again. And I call these the silent killers, because these are the things that are going on that you may not even be aware of, and they're going to have a huge impact on your trading success. The first problem, and probably one of the largest, is overtrading. 90% of traders overtrade. Money management. Most traders have little or no idea what correct money management is for their trades. And then, of course, there's the market mix. Very few traders ever consider what their market mix is going to be. So we're going to address these three issues here today and show you how this could perhaps make you a more successful trader. So as I mentioned in the coaching that I do, this is probably the number one problem that I come across. Traders are always coming to me and they're saying, Eric, you got to help me with my trading. What am I doing wrong? And I take a look at their trades, and again, almost without exception, they're overtrading. They're just trading far too often. And I think that all stems from a production mentality. You know, we all have this in our mind that if we can only take more trades, we'll make more money, right? Like if we're working on a production line, if we produce more widgets, we're going to make more money, or whatever it is that we're producing. The problem with that is that the probabilities fall as frequency increases. It's not a one-to-one relationship such as it is in the non-trading world, where you can say, okay, I'll work harder, I'll produce more, I'll make more money. Well, in trading, you can trade more, but you won't necessarily make more money, and in many instances, you're probably going to lose, and lose more money the more you trade. What people fail to recognize is that it is much easier for you to find 2 or 3 winning trades than it is to try to find 20. Just a real quick aside here, a couple years ago, a fellow came to me for coaching, and he said, Eric, I want you to teach me how to be a day trader. I want you to show me how to take 100 trades a day. Okay, I can show you how to take 100 trades a day, I said, but I also said you will never be a successful trader taking 100 trades a day. Now I know there's the high frequency traders out there, and they're making all the news now, and everybody wants to be an HFT trader, but realistically, for retail traders, you and I trading from home from our computers, that's not a realistic option. We're not going to be able to compete with the HFT traders. We don't have their resources. We're not set up right next door to Wall Street and the trading exchanges. We can't trade like they do. So we have to be a little bit smarter. And one of the ways we can be smarter is actually by trading less. So let's just take a look at this production mentality and why it's a problem when it comes to your trading. Let's take a simple coin toss scenario. Now I know some of the mathletes in the room are going to take exception with my example here, but at its core, a trade is essentially a 50-50 proposition. Yes, I know there's some other variables involved, but at its core, it's a 50-50 proposition. You're either going to win or you're going to lose. So in that case, it's really no different than flipping a coin. For every trade or every Coin toss, it's either going to come up heads or tails. You're either going to win or you're going to lose. So essentially the odds of taking one winning trade is 50%, right? It's going to win or it's going to lose. However, the odds of taking two winning trades in a row drops considerably to only 25%. 25% of the time you'll take two winning trades in a row. If you try to take three winning trades in a row, or you try to toss heads 3 times in a row, you're only going to do that 12.5% of the time. If you go for 4 winners in a row, you're only going to do it about 6.25% of the time. And if you try for 5 or more in a row, well, it's like they say in the old gangster movies, forget about it. It ain't going to happen. Or if it does happen, it's going to be extremely rare occurrence. And yet, how many traders try to take 4, 5, 6, 7 trades in a day thinking that this is what they have to do in order to be successful, not realizing that the whole time they're stacking the deck against themselves and probably getting themselves to a point where they may never be able to recover, and eventually they end up busting their account. So what's the solution to this problem? Well, I'm a big proponent of setting a trade quota. I think you set a limit for how many trades you want to take that day. Most people don't realize that you can actually make a living on just taking 2 trades a day, and I'll expand on that in a moment. The key is not frequency. Rather, the key is correct capitalization. Not trading more or more often, but trading correctly. That means putting the correct amount of capital at risk for each trade. That's a huge key to your success. So what about this setting a trade quota? How do you do that? Well, as you probably guess, I'm a big fan of the less is more school of thought. You really only need to take 2 or perhaps 3 trades a day to be a successful trader. Again, this just flies in the face of the whole high frequency trading trend and the whole production mentality where you think, oh, I got to do more, right? I need more signals. Let's throw another indicator on the chart. Let's tweak our indicators a little bit more. Let's get more signals. No, that's not it at all. If you take 2 or 3 trades a day, this does a couple of things for you. First off, it improves your chances of being profitable at the end of the day. Secondly, it also gives you the opportunity to cherry pick your trades. When you know you're only looking for 2 or 3 trades in a day, you can be a little bit more picky. The important thing here when you set yourself a trade quota is that you want to finish the day with a positive result, right? You don't want to have your quota and finish the day in the red. Let's take a look at an example here, and hopefully it'll make a little bit more sense to you. So let's say we set up and we're going to take a 3 trade quota. We're going to look for 3 good trades in the day. And as seems to happen more often than not, sometimes that first trade that you take tends to be a stinker, and let's say you end up with a $300 loser. Trade number 2, a modest winner at $100. Trade number 3, a modest winner at $100. You finished your 3 trade quota, but you're still $100 in the hole, in the red. So we've met our quota requirements, but we don't have a positive result. Therefore, we're going to take another trade. And let's say trade number 4 is a $200 winner. Hooray, we've got a $100 profit. So we've made our 3 trade quota and we have a positive result. What do? We stop trading. Simple. You finished the day, you've made money, you've met your quota, you stop trading. The secret is that once you can finish the day with a positive result, you increase your earnings with position sizing, which is totally different than frequency of trading. As you've seen, the more you trade, the more likely you are to incur a loser. However, if you limit the number of your trades and you finish the day with a positive result, you can increase your earnings by increasing your position size. And I'm going to speak to that more in just a moment here. Now, when you're doing this trade quota idea, you need to have a maximum drawdown safety net. For me personally, I risk 5% of my trading capital. That's an amount that, I give the market a fair shake on the day, but it's not so large that if I hit my max drawdown, it's not an amount I can't recover in a day or two, right? It's not going to devastate my account. So there's going to be those days, they seem to crop up once every quarter or once every couple of quarters, where the market just throws you curveball after curveball and you keep swinging and you can't hit it and you take loss after loss after loss. Okay, fine. If you hit your max drawdown, that's it. You say, okay, the market's got my number today. I'm going to pull the pin and I'm going to go do something else. This is a very important concept because I have met not one, but two people who have burned through a $20,000 and a $25,000 account respectively in a single session. How is that even possible? Well, because they obviously did not have a max drawdown. Well, they did. It was their entire account, but you get my point, right? If you have that max drawdown, and 5% I think is a good rule of thumb, you survive to trade another day. And capital preservation is really the hallmark of good trading. It's also important to remember that your job as a trader is to take what the market is giving. There's going to be some days where the market's just not giving, or maybe not giving very much. In fact, I tell people in our trading room that everybody should print that off and frame it and put it in their office above their trading computer, that your job as a trader is to take what the market is giving. So here's a secret that you can learn from the pros. The pros focus on quality over quantity. As I mentioned, if you're only looking for 2 or maybe 3 trades a day, you can be picky. If the setup that you're seeing, kind of gives you a little pit in your stomach, a lump in your throat, you just don't feel good about it, don't take it. You don't have to chase bad signals. You're only looking for 2 or 3 solid setups in the day. Pros also know the odds of their trades. And by that I mean when they're seeing a particular chart set up, and I'm sure you've seen this as well, that you can look at a chart and you can say, yeah, all right, I've seen that before. That's got a very high probability of success. And pros will know whether it's going to be a 50-50 probability or a 60 or a 70 or an 80 or whatever. They know. So again, they can cherry pick. They can hold out for those good trades, wait for those to come along. And the pros also know that they need to trade size in order to be successful. So how do you trade size? All right, money management for traders. This is a key component to your trading success. 90% of traders never give any thought to their money management. And again, I get this from the coaching that I do, the mentoring. Easily 90% of traders that come to me for coaching never ever consider money management. They're just looking at entry signals. Give me a better entry signal. I need to eliminate those losers. Well, you're never going to eliminate all the losers. Therefore, you need good money management. Now, money management is not risk-reward ratios. I could go off on a tangent here and probably spend a whole hour telling you why risk-reward ratios don't work and why professional traders trade probabilities. They'll reference risk-reward ratios after a trade is done. But the Reader's Digest version of the argument is that By focusing on risk-reward ratios, you're focusing on the reward side of the equation. The reward side of the equation is the part of the trading equation that you have absolutely no control over. So why should that part of the equation give you a go, no-go decision on your trade? Better to focus on the probabilities and to focus on the risk component, because those are the two things that you do have a little control over. Certainly the risk component, which brings me to the last point there, where the whole key to correct money management is never risking more than you can afford to lose. Very important concept. If you take nothing else away from this presentation this afternoon, that fact alone will do more for your trading success than anything else you can do as a trader. I know, I get a little bit passionate about it. I'll put the soapbox away for now. All right, let's take a look here. The reason the money management is so important is that the pros know there's a real possibility of hitting 10 losing trades in a row. So if you're risking too much per trade, which is what I see most traders do, it doesn't take long before you've blown through your account or you've crippled your account to the point where you can't trade anymore, and you're left scratching your head saying, what happened? And you, again, blame your signal. You look at this new shiny indicator or that, and you think that's the key. No. The key is to never risk more than you can afford. And for most traders, that means never risking them more than 5% of their capital per trade. That's most professional traders and money managers agree that 5% or less is adequate. 2% of your capital is considered the ideal. Now, of course, that's going to vary with your account size. If you're a small account trader trading a $10,000 account, you're going to be leaning closer toward the 5% margin. If you're a well-funded trader trading $100,000 or $200,000 or $300,000 accounts, well, you don't even need to trade 2% of your capital. You can get by quite comfortably trading 0.5% or even 0.25%. If you're, this whole 2% concept is that if you're trading, say, a $20,000 account, that means you're going to have a maximum risk exposure of $400 per trade. What most people don't realize is that if you trade this way, you can even make money with a 50-50 signal. You can be wrong half the time or right half the time, however you want to take a look at it, and you can still make money if you manage your capital correctly. Now, we've got that link there that you can go visit after the presentation. It's a great little tool. It's called the Money Manager, and it will demonstrate for you how this whole concept of position sizing and managing your risk correctly actually plays out on some simulated trades. So what do the 90% of losing traders do? Well, 90% of traders tend to risk more than they can afford to lose. 90% of traders also strangle their trades because they're scared of losing money. Well, we're all not fond of losing money, but you should never be a scared trader. So what they end up doing is they end up jamming their stops in so tight in an effort either to maintain some fictitious risk-reward ratio, or that they're just flat out scared about the money that they have in play, that they never give the trade a chance to work out. So what ends up happening? Well, they end up losing big and they end up winning small, which is the exact opposite of what you should be doing. The good news is that managing your risk correctly actually solves all these problems for you. Here's an example. Two identical charts, two trades, both on the same entry. This, by the way, is the Hawk micro scalper from Indicator Warehouse. So we're generating a scalp signal. Both trades have $360 at risk. Can you spot the difference? Well, the trade on the left is only trading 2 contracts, and it has the stop well below the swing low. The trade on the right is also risking $360, but it's trading 6 contracts, and it has the stop below the more recent swing low. So you see, you manage your risk, you keep your risk constant, but you manage your risk by changing your position size, depending on where you want to place your stop. Now, which trade has the higher probability of success, would you say? Which trade is more likely to hit the profit target before it hits the stop loss? Well, probably the chart on the left, don't you think? It gives the market a whole lot of room to move against it while still giving it a good opportunity to hit the profit objective. Now, keep this chart in mind because we're going to draw on this information here in a couple of slides. So the chart on the left, we're trading 2 contracts. The chart on the right, we're trading 6 contracts. But the risk amount never, ever changes. So are you like most traders? Do you lose big and win small? Do you start your trading and you say, oh, I'm going to be a very conservative trader. I'm only going to trade 3 contracts because I'm a small account trader. Well, what's the problem with that, you say? Well, for one thing, you're not keeping your risk constant. Your risk is going to change depending on where you place your stop. That means you may end up risking more than you can afford to lose. Right? In that slide that I just showed you here, this was set at 2%. This $360 is 2% of my account. So regardless of where I place the stop, it's still capped at 2%. So you may end up risking more than you can afford to lose. And not only that, you're not maximizing your winning trades. You saw on that, again, on that chart, the one scenario had 2 contracts in play, okay, but the other one had 6 contracts in play. So if you're trading 3 contracts all the time, well, you may be leaving a lot of money on the table because you could actually afford to trade 6 contracts. So you could actually be earning twice as much. All right, let's take a look at an example here, how this works, and it may help drive this point home. So typical trading day, right? You say, okay, I'm going to be a conservative trader. I'm going to trade 3 contracts. Trade number 1 out the gate. The market gives you a little bit of a spank there for $150 per contract. You end up with a $450 loss. All right, whatever. It happens. Next trade, you go in, 3 contracts. You give the market a little bit more room to move, and it gives you a stop out for $200 per contract. Now you have a $600 loss. So you're 2 trades into your day, and you've got a $1,050 loss already. So now what do? Well, now you're getting a little bit gun shy, aren't you? So you say, ooh, I'd better be careful. So I'm going to reduce my position size from 3 contracts down to 1. And inevitably what happens? The 3rd trade is a winner. You make $200, hooray, but you still have an $850 loss. So what could we do better? All right, let's pretend we have a $20,000 account and we're going to risk 2% and we're going to do these same 3 trades. So the risk is capped at 2% of your trading capital. That means trade number 1 is a $400 loss, right? That's our max. That's all we've got prepared to lose. 2%, $20,000, $400. Trade number 2, also a loser, but here we've lost $390 because now we only have $19,600 in our account because of that earlier loss. 2% of that, $390. Trade number 3, our $200 winner, hooray! Well, let's say we traded 4 contracts. Remember that chart that I referenced earlier where the one we were trading 2 contracts and the chart on the right we were trading 6? Well, let's say we split the difference and we trade 4 contracts. Our $200 winner, $800. So we're essentially at break even, right? We've lost $790, we made $800. We're essentially sitting at break even now. However, if we had traded the 5 or the 6 contracts, we would actually be in a profitable position in spite of taking 2 losing trades. Did the light just come on? Are you starting to see the importance of position sizing and how it's going to save you from blowing up your account and even help you make money trading? It is a huge, huge lesson to learn. The key to your success is keeping your risk constant as a percentage of your trading capital. Not what most traders do, where they keep their exposure constant, where they say, oh, I'm always going to trade 1 contract or 3 contracts. Or I was working with a fellow who always wanted to trade 6 contracts. I said to him, you can't do that. You're going to wipe out your account. Keep your risk constant. Keep your risk constant, adjust your position size to reflect that risk amount. So that means sometimes you may be trading 1 contract, sometimes you may be trading 3, sometimes you may be trading 6. Keeping your risk constant also allows you or keeps you from strangling your trades. So if you know it's going to cost you $360 regardless of where you place your stop, wouldn't you place your stop a little bit further away to increase the probability of your success, to avoid the market stopping you out prematurely? Of course you would. And when you combine that with a trade quota and not over trading, well, then you have yourself a very profitable combination. Good news is there's an app for that. Indicator Warehouse has got the Trade Manager, which actually does all this for you automatically. It controls your position size. It even has stop strategies built in. So the Trade Manager will never, ever allow you to risk more than you can afford to lose. And at the same time, it's always going to maximize your profitability on a trade. And as I mentioned, there's 16 different stop strategies available to help you manage an open position. A lot of traders are at a loss at how they should manage their trades. Well, the Trade Manager, it's got 16 stop strategies. They're all customizable. This is what the Trade Manager looks like. It's the tool that's in the right margin there. You can see the bottom arrow is pointing at the risk module of the Trade Manager. Currently it's capped at 2%. So that means no matter where I place the stop on that chart, it will cap it out at 2%. And it will adjust the position size accordingly. You can also preset profit targets. You've got the stop strategies just above there, kind of in the middle of the Trade Manager there. The arrow that's slightly pointing up to the left toward those little blue dots, that is the stop strategy, the trailing strategy. In this case, the ATR strategy is selected, and that shows you how the Trade Manager would have managed your trade for you automatically. Once the trade goes live, Trade Manager does that all for you automatically. It really is a very impressive piece of software. And like I said, it's going to do a lot for your trading success. All right, the third component is market mix. 90% of traders never consider their market mix. Big surprise there. Most traders just end up trading whatever they consider to be sexy. Right? They don't think about how the market mix is actually going to influence or affect their profitability. but the markets you trade do have a direct impact on your overall profitability. Tick size matters because being able to afford multiple positions makes you a more profitable trader. Why? Well, multiple positions are easier to manage. If you're able to trade 2 or 3 contracts instead of just one, it gives you options. You can take partial profits, you can leave in a runner, you can set multiple profit targets. There's lots of things that you can do with multiple positions that you cannot do with a single contract. Single contracts, very, very difficult to manage. And yet, most small account traders never take into consideration that trading a smaller tick size would offer a lot of these benefits to them. So they ignore the markets with the small tick size, thinking that they're inferior. Case in point, the E-mini S&P versus the NASDAQ. The E-mini, of course, one of the world's largest and most popular markets, certainly gets the nod for sexy market, great market to be, hanging around a cocktail party and somebody says, "Hey, what do you do?" "Oh, I day trade the S&P." "Oh, really?" Everybody knows about that, right? The E-mini tick value is at $12.50 a tick. The NASDAQ, by comparison, is only $5 a tick. The E-mini, obviously the more popular of the two, but is it more profitable than trading the NASDAQ? Well, on the surface, you might say yes, because people assume that bigger tick values mean more profit. That's because traders assume that markets move the same number of ticks. Therefore, if the E-mini moves 10 ticks, then the NASDAQ must also move 10 ticks. So if the E-mini is worth $12.50 a tick, well, that's $125. And if the NASDAQ moves 10 ticks, well, that's only $50. So I make more money trading the E-mini. Therefore, the assumption is that the higher tick value market is more profitable. But is that right? Well, a lot of people only look at this stuff on the surface without actually ever looking at it. And the fact of the matter is that small ticks can mean bigger profits. Because what happens is the markets tend to move equivalent dollar amounts, not the equivalent number of ticks. Now, this isn't carved in stone. It's not a direct one-to-one type relationship, but generally speaking, if the E-mini moves $100, which would be 8 ticks, then the NASDAQ is also likely to move $100, even though that's 20 ticks in the NASDAQ. But the NASDAQ is only $5 a tick. That means you can trade 2, or depending how the trade sets up, sometimes 3 contracts for each E-mini contract that you can afford. Therefore, if you're trading 2 or 3 times as many contracts in the NASDAQ than the E-mini, but the NASDAQ and the E-mini tend to move, relatively speaking, an equal dollar amount, you can potentially earn 2 or maybe even 3 times as much money trading the NASDAQ versus the E-mini. Now, again, it's not a direct one-to-one relationship. Sometimes the E-mini will move $100, the NASDAQ may only move 80. But the point is still the same. If I'm trading 2 NASDAQ contracts, that's still $160 versus the $125 that I would have made in the E-mini. So considerations for your market mix. Well, obviously you need a market that has adequate volume, right? You don't want to be trading something that's ultra thin. You're not going to get good fills. You also need good volatility. You need the market to make a decent range during the day, well, especially if you're day trading. The adequate volatility also leads to adequate follow through on the signals. You want the market to find your profit target, or at least, if you're going to run out a trade or take partial profits and run it out, you're hoping that the market's going to go somewhere. Also, you don't want to follow too many markets. I see a lot of traders, especially new traders, they'll follow 4 or 5 or 6 markets thinking that, again, that whole production mentality, if I do more, I'll earn more. And yet, some of the most successful traders I've ever met will follow fewer than 3 markets, 3 or less. The 1, 2, or 3 markets at the most. So what are good small markets, small tick value markets for you to consider? Well, my personal favorite is the NASDAQ. I think it's pretty tough to beat. $5 a tick. It's got excellent liquidity, excellent intraday volatility. Very close second is the mini Dow. The mini Dow perhaps a little smoother, a little gentler. And then there's even like the ETFs, such as the SPDR. And the symbol for the SPDR is the SPY. And it offers you the ultimate in customization. You can trade 1 share, you can trade 100 shares, you can trade 1,000 shares in the SPDR. So you have the ultimate flexibility when it comes to maintaining your risk exposure. And we've already seen how important that is to do. So if you haven't ever considered these 3 markets, I urge you to take a look at them. I think you'll be pleasantly surprised at the options available to you. So there's the 3 items that we looked at: the overtrading problem, the money management problem, and the market mix problem. 3 things that you can do right now, today, to improve your trading. And I guarantee it will improve your trading. So now the big question is, are you prepared to do what the 10% of winning traders do? Because I guarantee you that the winning 10% do not overtrade. They are vicious money managers, ruthless. They will manage their positions so well that they can't help but make money. And they pay close attention to their market mix. They want to get the most bang for their buck, quite literally. Or are you going to continue to do what the 90% of traders do and leave the webinar here and go to the internet forum and see what the latest settings for your favorite indicator are? Because 90% of traders, they are signal obsessed, and they will be signal obsessed, which is why they will continue to lose money. I've got this little comment here. What George Costanza taught me about trading. George Costanza, of course, that character from Seinfeld. I wrote a blog post about this probably about a year ago, and George Costanza, in one of the Seinfeld episodes, did an experiment. He was frustrated with his life as usual, but this time he decided to do something about it, and he decided to do the exact opposite of what he had been doing. The logic behind that is actually not that crazy, because he figured, if what I've been doing so far got me to this point in my life, if I do the exact opposite of what I normally do, I should end up somewhere else. And I think it started by him ordering a different sandwich than what he normally ordered for lunch at that little deli that they always frequented. And by the end of the episode, he was manager of the New York Yankees or something like that. But the point is, if you continue to do what the 90% of losing traders do, you will continue to lose money. Nothing magical is going to happen. But if you start to concentrate on these things that we pointed out to you this afternoon, it's going to make a change, and a change for the better. All right, I'm putting my soapbox away now. We've got some thank yous here for those of you attending the presentation today. And the crude oil manual I'm sorry, I forgot to activate the link. So you may just make a note of that link. Please go back to it a little bit later. It may not be active right now. I'll leave it active for an extra day. So if you don't get to it today, you can get to it tomorrow. And that's a manual that normally sells for $49.95 at the website. So if you're interested in trading crude oil, you're looking for a crude oil strategy, well, here's one that you can have for free. And there's also a couple special reports, one from Indicator Warehouse, an easier way to trade, gives you a little bit of information about the DTS system. And by following that third link, you can also get free access to the Indicator Warehouse trade room the next time we have our open house. All right, Adam, I will turn it back over to you. And thank you, everybody, for your attendance. I hope that it was at least a little bit informative. And I do encourage you to keep an open mind and maybe try to implement some of these things we've suggested to you. Yes, I know, Ryan, that link is not active. My fault. I forgot to activate it. The webmaster, I've got an emergency email into her. She will turn it on. Please just make a note of that, and you'll be able to access it later today, and I will leave it open tomorrow as well. So if you don't get it today, you can get it tomorrow. My apologies. All right, Adam, it's all you.
Hi, folks. All right, so I've been feverishly typing away in the background for people who've been asking questions. So I think I addressed, everyone along the way. If we missed something, or if there's something that you want to go in more detail, and dig into, let me give you some contact information, and I'm happy to address. So if you want to reach me, and anything related to Indicator Warehouse or any of the products or services associated with it, including getting access to Eric on a more professional level, do that. And in fact, really the best way to get a hold of me is to use that service. Whoops, that's not correct. Hold on. Sorry. Let me get you this. That way we don't play the back and forth, hey, are you available game? And there we go. And if you have any trading specific questions, or clarifications on any of the charts that you saw today, or the concepts that Eric covered, there's Eric's direct email address. And I can just tell you, I'm not ashamed. It took me about 6 months before I could really wrap my head around the power of position sizing and what it was all about. And but once it clicked, quite frankly, if I had my way, that's really the only product we would sell. Unfortunately, a lot of people just either, I don't know, they don't get it, or they're so wrapped up in, searching for the ultimate signal that that's all they want to talk about or care about, and don't realize that really it's about capital preservation at the end of the day. Trade Manager is by far the product that I most often get a call 2 or 3 months later saying, why didn't I know about this a year or two ago, or, whatever. Because it's one of those concepts that it's an aha moment when it clicks, and then you look back and go, oh, wish I'd known this back then. I'm going to put hang on one second. I'm going to put this link back in there just because if you do have time, on this page that I just put in there is another presentation that Eric did specifically about money management, risk management, position sizing, etc. And it's excellent. And as you can tell from today's presentation, Eric is a gifted teacher. So any specific questions for me or Eric, before looks like we have about 7 minutes left. I'm going to look in the chat window and while you all are typing. You want to stand by? Let me just read one more. Can you sum up? Okay, Eric, I don't know if you saw the question. There's can you sum up why trading oil is different than the YM outside of specific news events?
Well, it's not really that different. There's the old adage that a chart is a chart is a chart. And the reason people say something like that is because support and resistance, supply and demand, price action, these are all the kind of underlying things that will drive the market, regardless of whether you're looking at the YM or gold or soybeans or crude oil. So when you're looking at a market like crude, probably the biggest difference in trading crude is things that are crude specific, namely crude is expensive. There's no question about that. It's an expensive market to trade. You want to be well funded. Crude can also be very volatile, although admittedly it's been quite tame about the last 3 or 4 months. And crude oil is also kind of unique in the way it follows through on some of its setups. Even though markets are very similar, they also have their own little personalities, their own little quirks, which is why I normally encourage people to become familiar with one market. And then once you're used to that market, if you want to add a market to that mix, then by all means add another market. But it's important to learn the little quirks that each market presents you with as well. And crude oil definitely have some quirks that you're not going to see in the YM and vice versa. But a lot of similarities, but subtle differences as well.
All right, so Ryan asks, so how much emphasis, percentage, do you place on indicators, or do you use them at all? So I'll take a stab at that one, Eric. So we are called Indicator Warehouse. So obviously we see some value in them, but I'll answer it this way. I get the phone calls from individuals who are like, I think indicators are for weaklings and they're crutches, and I just I trade on a clean, naked chart. And my answer is great. I mean, if you've put in the time necessary to train your brain to see patterns such that you no longer need any kind of visual assistance, that's fantastic. I mean, that's where we all want to get to. However, most normal human beings don't get there overnight. And so my view of indicators is that, like all software, it simply helps you do your job better. Doesn't do it for you, contrary to what most of my competitors will say. Software will never do the job for you. What software will do is enable you to do whatever you're doing easier, better, quicker, more effectively. Just like a word processor doesn't write the book for you, but if you're writing a book, it sure makes that process easier. So the two components that I see going into this thing called day trading is, yes, there's the signal piece, which, as Eric said, is probably 10, maybe 20% of the equation. And then there's the money management, which is, I think, the most important, and then, of course, being capitalized correctly. And the reason I say that is, when I'm working with prospective customers, the first question I ask them right off the bat is, are you currently working with an entry system or a signal that you like? Because if the answer is yes, well, then why throw out the baby with the bathwater? You don't need the diversified signal generators or whatever else is out there. All you need, and this happens a lot, is just good money management to take whatever signal you're using and add the power of proper risk management. And so it's only when I speak to individuals who don't have a system they're currently working with or some kind of entry methodology that we start talking about indicators, or a collection of indicators with the methodology wrapped around them, what we call a system. And that's when we start discussing things like the diversified approach, which I'm not going to go into now. But if you want to discuss that, offline, email me, set up a meeting with me, whatever. I'm happy to go into that in more detail. So,
Adam, if I can just interject, I'd like to use the analogy of a stool, right? You need 3 legs for that stool to remain upright. So the entry is only one of those legs. Money management and how you manage that trade are the other 2 legs. So once you have all 3 legs of your trading stool, that enables you to be, or at least tips the odds in your favor of being more successful.
Okay, this is a quick one from Leon. He asks, is the room free? And the answer is yes and no. I don't mean to be, coy here. So here's another thing that sets Indicator Warehouse apart from most other vendors out there. and that is the services or support that comes with investing in our software. Because in my opinion, having been doing this now over 7 years, having good trading tools is the price of admittance in this business. Everyone has to have that. It's the company wrapped around that software and the support that the end user gets that really makes the difference. There's just so many what I call Tony Ponytail shops. Some guy who bought a $50 HTML template, threw up an indicator, and now he's, quote, a vendor. So our approach to our trade room is that, yes, it's private. However, it is accessible as a system owner for the lifetime of your ownership. Basically, once you invest in the software, you get the software. There's no ongoing fees. There's no subscription. None of that silliness. In addition, there's no ongoing fee or cost for the trade room, and so it's free. I know that sounds crazy, but we do not charge for our members to be in the trade room. Now, I get this question all the time, what about a demo? What about a trial? And, over the years, we've tried many different ways to address that question really in the most effective way possible for somebody who's new to get that answer, because let's face it, the question they're really asking is this going to work, right? And so what we have found works the best is a twofold approach. One is once a week, every Wednesday, we open up our private trade room to the general public. You get to come in and see what everybody else gets to see and, ask questions, whatever it may be. In fact, here, I think I put that earlier there, put the link in there. Get the access to Eric, etc. The other days, so that's Monday, Tuesday, Thursday, and Friday, those are private sessions. However, we record each one of them and we put them out on our YouTube page for people to review. So nothing to hide. It's just the difference between being a system owner and access to the private room during the week versus watching them on YouTube is when you're a system owner, you get the luxury of interacting with Eric and asking him questions and learning as you go. That's the primary difference. But if you want to see how this money management works in the real world or how our diversified signal generators work in the real world, that's out on our YouTube channel, which let me put that in here. There you go. So anyways, that's the long answer to a very short question. Let's see what else we have here. Tim asks, I like to trade late at night. Do you have any futures instruments that you prefer trading later in the evening and around 2 a.m. Central Time? Eric and I had this discussion just the other night. I'm going to answer on his behalf, but Eric, feel free. I'm assuming Eric's going to say the 6E, but Eric, what's your answer?
Yeah, definitely. Anything that's native to that time zone. So 2 a.m. Central, that's, sorry, I'm stumbling over my words here. That's when the market opens in London. That's the London market open. So yeah, I'd be looking at things like the euro, the British pound. I would be looking at the DAX, the Stocks 50, the CAC 40. Gold is a great 24-hour market, regardless of what time zone you're in. Gold is always active, 24 hours a day. Brent crude would be very active at that time, as would cocoa, because a lot of cocoa is traded on the London exchange. So lots of options for you, and I'd be looking at those markets that are native to the European time zone.
Yeah, so actually, if you go to our site, I put the link in there. There's a great day trading, session clock that I found, and we put it on our site. It's just I like it because it shows the overlap of the different sessions, throughout the day. Obviously, when you see overlap, that's when you're going to get the highest volatility and probably the best trading. So you'll see, when New York is shutting down, then London's picking up. If I didn't have kids, I would probably be up at 2 a.m. trading the London session, but I still have to have a life. So, but that's on our site. You're welcome to go there and bookmark it if that's helpful to you. So Tim asks, what do you consider a good winning percentage for trading and a risk-reward ratio per trade? I'll have to be careful on my answer there, Tim, because, well, I'll let Eric answer it. You may not like his answer, but I would say that's irrelevant. My answer is that's irrelevant, but it's all about really the percentage of your trading assets is really what you want to be concerned with, and not get caught up on the entry signal. But Eric, anyways, what do you have to say?
Well, yeah, it's again, we've all got those emails in our inbox, and it's funny, they used to start at new trading system delivers 74% win ratio, and they've crept up from there, where I just received one the other day that actually said new trading system delivers 100% win ratio. It's like, really? You're going to tell me this signal never fails? Well, it's not the win ratio, it's not the risk reward. You can make money, as I've shown you, on a 50-50 system. In fact, I will tell you, one of my most profitable months ever, I was only right 40% of the time. I was wrong more often than I was right, but I had one of my most profitable months ever. How is that possible? By correctly managing your money, so that when I lost, I never lost more than I could afford. When I won, I was always correctly capitalized so that I would maximize on my winning trades. And even though I was wrong more often than I was right, I made one of my most profitable months ever, hands down. So to answer your question, you can get by with the 50-50 system just fine. Ignore all those emails that you quote these astronomical winning percentages, because Wall Street would go nuts over a 50-50 system or over a 55-45% system. Wall Street knows that all that other stuff is garbage. You find a system that performs at least half of the time, maybe slightly better. You combine that with correct capitalization, and you watch the frequency of your trades, and you can't help but make money. Honest. It's really, that's what it boils down to. And the funny thing is, you never hear anybody talking about this. I always call this the best kept secret on Wall Street, because everybody's talking about signals. Nobody's talking about how you actually make money. And that's how you make money. Try it. Try it in sim. Do a little paper trading. You will see for yourself. Don't take my word for it. Try it. It will work. I guarantee it.
Yeah, and we believe so strongly in this that I actually contracted some programmers to design an online application that demonstrates the power of this position sizing or risk management. And that's the link that I just put in the window there. You can run different scenarios with different account sizes, different win ratios. You can, really put this theory to the test, and you will see that even if you have, well, I would argue even less than a 50% quote accurate signal, good money management will always make a mediocre signal more effective. So, yeah, that's, oh my God, my soapbox for a while. Sorry about that. Okay, any other things beyond this topic? Because I feel like we're beating a dead horse. Anyone who wants to discuss, money management, position sizing, et cetera, in more detail, definitely reach out to me. You have my meeting link, you have my email. Anything beyond that anyone wants to talk about right now? All right. Well, we went a little over, so I apologize for that, but it feels like we had some really good questions. So you have our contact information. Again, thank you for your time today. I hope you all got some value from it. Eric, thank you for being able to show up for this. And Brant, we'll hand it back to you.
Awesome, guys. I'd like to give a special thank you to Adam and Eric of Indicator Warehouse for a great presentation today. NinjaTrader is pleased to sponsor these weekly partner events at a value-added service for our clients. If you find value in these events, we hope you will attend them on a regular basis. Quickly put that in the chat room here for you. Again, we appreciate the time you spent with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us at NinjaTrader. Thank you.